So in 2020, 2021, 2022, real estate market was absolutely booming. But Fed started jacking up interest rates, which ruined everything for real estate investors. I'm in Long Beach, California, in front of Blueprint Home Loans with Jeff, the mortgage expert. And we're going to be asking him all questions about lending. Let's dive in.
Yeah, I'm Jeff Welgan with Blueprint Home Loans. I live in Laguna Beach. I work in Belmont Shores, and I've been in the industry for 19 years, and I specialize in helping my clients build and scale their real estate portfolios.
Okay, Jeff, how did you get started?
Funny story. So I knew at a young age I wanted to get into real estate. I went to Cal State Long Beach and I got my degree in finance with a specialty in finance, real estate, and law. And I ended up getting into the industry back in 2003 when one of my friend's uncles actually had a mortgage company. That was an interesting 5-year run up until the collapse. And yeah, it's been a long road.
Jeff, what's the day in the life look like for you?
That is a great question. It changes day by day, but right now life is pretty exciting. Process of building and scaling our mortgage company. I'm learning how to become a better mentor to my loan officers that are underneath me, and I'm loving every minute of it.
Okay, Jeff, so we are mid-July 2023. Give us an update on these damn interest rates. When are they coming down? That's what everyone wants to know, right?
It's the $1,000,000 question, Alex.
Right.
Everybody wants to know the day and time.
Yeah.
Good news is with last week's inflation reading, they are slowly back on their way down.
Okay.
We should see lower rates later this year.
Okay.
Problem is if we hit a soft landing like the Fed thinks we're going to be able to, it's probably going to keep rates elevated a little longer than we'd all like, but lower rates are coming sometime next year.
So what key pieces of data should the public start looking for?
The employment number and the inflation, the CPI inflation reading that comes out on a monthly basis.
Okay.
Inflation is easing. It's come down about 50% from where it was last year.
Right.
It's just not coming down fast enough. And so the Fed is trying not to make the same mistake that they made back in the 70s and 80s, where when inflation was on its way up, it hit a peak, they thought. They took their foot off the gas too quickly, reversed monetary policy, and started lowering the Fed funds rate too quickly.
Okay.
And that's when inflation shot up. So this time they're going to overdo it. We're going to see the Fed raise the Fed funds rate again later this month, most likely again in September, and then fingers crossed that's going to be the end of their tightening policy.
So tell me something here, because it makes absolutely no sense to me, and I've been investing in real estate for over 20 years. Are increasing interest rates, but yet housing prices are going up. That was the deal.
Yeah,
dude.
there's no supply. I mean, the bottom line is this is a fundamental supply shortage in this country right now.
Okay.
And so when you look back at 2008, a lot of people like to make similarities or compare it to the Great Recession.
I was trying to think of that.
I mean, there's so much negativity out there right now that's being spread because it generates advertising dollars.
Yeah.
Bottom line is this is not 2008 all over again. We were doing terrible loans back then, and the builders overbuilt. So there was way too much supply, not enough demand. This time around, the big difference is if you look back to the 80s, there was a birth rate spike during that time period. All of these young adults are coming of age, they need somewhere to live, and the builders stopped building after the Great Recession. They learned their lesson, and so we have about a 3 to 5 million home shortage in this country, and that's why Wall Street and the institutional investors have been buying real estate hand over fist the last 5 years, because they saw this coming. They knew they were going to be able to rent these residential real estate to all of these young adults that are coming of age, or sell it at a profit.
So I help a lot of healthcare workers invest in real estate. I kind of guide them through. Let me ask you something. Is homeownership dead? Because I look at a new grad nurse, I'm like, I don't know how you're going to afford this at all.
I mean, absolutely not. So the big shift or change that's happened over the last year to 18 months is we're going through a period very similar to the mid-90s during the Clinton administration, where the big push was to get as many first-time home buyers and low to moderate income families into homes. And so we're seeing that trend again, where there's all this new down payment assistance money. It hasn't been easier in 30 years to buy a house with little to no money down, where in most states we can do up to 105% financing.
105%?
Yeah, 100% of the purchase price.
They're not having to put any money down.
100% of the purchase price, 5% of the closing costs. We have clients that are buying homes with less than $1,000 in some parts of the country.
Okay.
And then that program, you cannot have owned a home in the last 3 years. That's the first-time home buyer rule. There's also another program that came out recently for our clients that either own a home currently or have owned one in the past that does not have a first-time home buyer restriction, where we can go up to 101.5% financing.
Oh, wow.
So that was a game changer that's opening doors to everybody basically can come in and buy a primary residence.
So that begs the question. So if there's a larger buyer pool out there, will that start, I guess, spiking home prices?
That's a great question. Yeah, so really what we've seen over the last year, the only thing that's changed is interest rates have doubled quicker than they have ever in history, and there's a lot of fear out there. So fear and high rates are keeping a lot of people stuck on the sidelines at the moment. And what we saw earlier this year, at the beginning part of 2023, was as rates dipped from 7 down to 6% or in the low 6s, the demand side picked up, which has caused property values to start rising. That's why they didn't collapse. The bottom looks like it was probably November of 2022. That was the time to buy. And the inflection point that we see coming, where a good majority of these pre-approved buyers that we had pre-approved a year and a half ago will be able to qualify again. It's going to be somewhere around 5.5% to 6%, which, if things keep going the way that they are with interest rates, we should see that sometime next year.
I know me as an investor, we have tons of equity in all of our homes. And I want to do a cash out refinance, but I'm like, not at 8%, dude. Like, you know? And so I feel like for me, speaking to everyone, like if it starts coming down around 5.5% or so, I'll refinance all these 3-4% interest rates that I have, grab that money and go buy more real estate.
And what we're recommending is to look into equity lines first. Primary residence and second home equity lines are available. They've stayed available throughout all of this. The investment side they went away for all intents and purposes for a while. They're starting to come back. I'm not recommending cash out refinances on investment property loans because the rates are so high and the cost is so high. That's been part of this big shift of the government. They really want to slow down investors from continuing to build and scale their real estate portfolios. And they've tried to make a lot of these programs almost cost prohibitive, make the numbers not work. That's why it's so difficult for all of these short-term rentals that you guys are analyzing, why they're not working, because they've increased the spread between primary residences and investments, where, 2 years ago, the first, let's call it 18 years of my career, the primary residence rates and second home rates were only about an eighth difference, and investment property rates were about 3/8 to a half a point higher than primaries. What they've done is they've increased that spread now to where it's about 3/4 to a full point, and made second home loans synonymous with investment property financing. Right. So that's why it's become so expensive. And then they rolled out points on basically all of these loans, like they did with the second home loan with that 4-point hit. They really wanted to slow down investors from using that program, because that program and the 15% down option were the preferred methods to build and scale quickly.
Right. So it was really the government slowing down short-term rentals. We talk about regulations, but it's almost impossible to make the numbers work. So is the 10% vacation home loan, well, I guess a lot of the viewers don't even know, you could purchase a secondary home with just 10% down. I think that's a myth, right? That people will have to have 20% down. So can you still get those loans today?
Yeah, they never went away. What ended up happening was with that 4-point hit, what the government rolled out last year, it made it so they were very difficult to do for a time, because the max we can charge is 3 percentage points. Right. So there's a workaround on it. Now there's options on the non-conventional side where we can go higher with the rate and even do no point options with those now. So yeah, they're very easy to get done. The short answer is yes, they're available. I know a lot of lenders out there aren't offering them. A lot of lenders are still saying 20 or 25% down minimum, but we're doing the 10 and the 15% down all the time.
Okay, so in the news recently, I saw that investors are getting punished if they have high FICO scores. Is that true? I don't understand the whole thing.
It's not just investors. So this is part of what we were talking about upstairs. The government's plan to really slow down people that they deem that have money. So on the higher end, higher credit scores, higher loan amounts have gotten more expensive. And really what they've done is made it more expensive on that side, because they're rebalancing their risk assessment of the general market. And they're really trying to make it easier for people on the lower end. So let's just say people that have credit scores below a 680 that are putting less than 5% down. It became less expensive for them. Still much more expensive than somebody that has a 780 credit score, but they're making it a little bit easier for them, making it slightly more expensive for the higher end. And then, believe it or not, for our investor clients that let's just say have 30% equity, pricing actually got better. So as long as you're not in that, let's say 80 to 90 category, or even 75 to 90 category, pricing either stayed the same or got a little bit better. If you're in that higher range there, especially on the investor side, it's got more expensive.
Okay, so should I tank my credit score to get a better interest rate?
Absolutely not. No.
That'd be a stupid move.
It'd be stupid. Yeah, because you're going to pay more in the long run anyways, because it's still more expensive to have a lower credit score, especially on the investor side. If you have a below 680, it's very difficult to get financing. You can, but it's expensive. On the primary residence side specifically, it's gotten better, less expensive, because they're back to the whole mentality shift here, the priority of Fannie Mae and Freddie Mac. They're trying to make this as easy as possible for low to moderate income families and first-time home buyers to start buying real estate, and are making it as difficult as possible and try to slow down investors and people that have higher credit scores from buying all the limited inventory that's out there right now.
So you're saying I should start paying my car note again?
Yeah, absolutely. Right. Yep, before they repossess it.
Damn it. Let me ask you about finding the right lender. What should people look for when they're shopping their lender?
It's a great question. Yeah. Especially as a real estate investor, there are so many lenders that are trying to jump into the space right now, because we just went through such a difficult year in my industry, that you really need to ask the right questions. What type of investing experience do you have? Tell me about the last 4 or 5 loans that you've done for real estate investors. And 9 times out of 10, you're going to be able to tell whether or not this is an investor-friendly, investor-focused lender just by asking those questions.
Right. So they shouldn't go straight to Rocket Mortgage or something like that.
They're good at a lot of things. Building and scaling real estate portfolios is not one of them, unfortunately. Right. So, and then just go. The other thing is, we all do it. Go online, check reviews, and really look for experience. Really need to see how long your loan officer's been in the business, because you're not going to learn how to be an investor-focused LO in 3 to 5 years. It's just, it takes years of experience to get to this level.
What's another program out there that can help a real estate investor right now that a lot of people don't know?
Yeah, great question. So the investor renovation option. So it's basically the fix and flip loan that we're adapting to a rehab style loan, where we have clients that are coming in, buying properties that need work, renovating them, and then turning them into short, mid, or long-term rentals.
How do they qualify for those?
There's a couple different options. So we have a conventional option that we do in-house, where you can do up to 4 units on a primary, 1 on a second home, 1 on an investment, and then then we also have the true investor renovation option. That's a 1-year bridge loan that we can do multiple units on investment property financing. Okay. So it really depends on what our clients qualify for. If you can qualify full doc, you're going to get a better rate on the conventional side than you will on the non-conventional.
So you're with Blueprint Home Loans. What differentiates you guys from everyone else?
Our creativity and experience level. And that's the bottom line. Because what we are an investor-friendly, investor-focused lender, and that's all we do is work with real estate investors. We're a one-stop shop for investors nationwide, so you can easily shift markets without having to shift lenders. And we're really trying to simplify the process and make our investor clients' lives as easy as possible.
All right, Jeff, so let's talk about a DSCR loan, because I know a lot of healthcare professionals or even a lot of investors, they always worry about their debt to income score when they do acquire all these properties. What is a DSCR loan?
The DSCR loan is the investor cash flow loan that investors use to buy properties without having to document their income and their employment. So what we do is it's actually the commercial loan that's been adapted to residential real estate, and we use we just look at the cash flow analysis of the property. So DSCR stands for debt service coverage ratio. It's a fancy acronym for does the property cash flow. If the rent covers the mortgage payment by $1 or more, it cash flows. The minimum is 20% down right now. The 15% down option has not come back yet, but it's slated to later this year. And then if it doesn't cash flow, so let's just say the rent does not cover the mortgage payment, then the minimum is 25% down at the moment.
So people without jobs, they could easily, or if they own a business, they can easily get the DSCR loan. So what's the negatives to it then?
Well, the negatives are because of the fact you're not documenting ability to repay the loan through income and your employment, it's a little bit riskier of a loan, so the rates are higher and the costs are a little higher than conventional options.
So we talked a little bit about the DSCR loan. When can you refinance a DSCR loan?
One of the things that you need to take into consideration when it comes to the DSCR loan is that it will come with a prepayment penalty period, and that impacts the rate and the cost. So you can do anywhere from a no prepay all the way up to a 5-year. And with these DSCR loans, there is a required rate of return with all of these loans. And so the investors are either going to make that money over time with a longer prepayment penalty, or they're going to compress that required rate of return in a much shorter period of time. So the lowest rates on the DSCR side are going to have the longer prepayment penalty periods. And if you want to get out of the loan quicker, then you're going to have to take a higher rate on the front end and a higher cost.
What's the prepayment penalty typically?
Great question. Yeah. 6 months interest, 80% of 6 months interest. So you'll have to pay that if you refinance, sell, or pay down 20% of the principal balance within that prepayment penalty period.
So let's say someone wants to get started and they want to do what you're doing. What advice would you have for them?
Call me. We're putting together an investor strategist program as we speak, because we're building and scaling our business. And we're looking for new loan officers, new support staff that want to come to work, that are creative, hardworking, and want to come in and solve problems for our clients.
Do they need like education, finance degree, or anything?
No, absolutely not. No, I mean, most people don't in my industry. So yeah, no, absolutely not. Hey everyone, I'm going to show you our Long Beach office for Blueprint Home Loans. Alex, come on in. This is our lobby. This is our amazing office manager, Randy. This is one of my assistants, Adam. Office for clients. So our branch manager, Hans' office. Little meeting area, recording area, his beautiful kids, and our conference room.
Jeff, give us 3 people to follow on social media, real estate investors.
Well, the obvious, Tony Robinson. I love Beardy Brandon. And third one, I like What's a Mortgage? I mean, he's on there all the time giving a lot of mortgage tips that aren't always investor related. So if you're interested in other types of loan programs, or if you want to be in the mortgage industry in a different side, he's a great person to follow.